The platform has a stop-out trigger to assist in mitigating the risk of negative equity. Margin call is when your margin level is 90%, and stop-out is when your margin level is 20%. For the MetaTrader platforms, a margin call occurs when equity on the account falls below 90% of the margin required for maintaining your positions, and an automatic stop-out will occur when account equity falls below 20% of the margin required for the trades. This percentage is constantly calculated and updated on your platform and is called margin level. If your equity falls below 20% of the margin required to maintain the open positions, they will be automatically closed. This is calculated as follows. Margin level. When the equity equates to 90% of margin used, this will result in a margin call warning. Margin level. When the equity equates 20% of margin used, this will result in a margin stop out. Let's break down what happens with different levels of leverage in trading using simpler terms. See example using 100-to-1 leverage. Imagine you have $1,000 in your trading account and you're using 100-to-1 leverage. You decide to open a 1.0 lot trade worth 100,000 units of currency. This trade requires 1,000 units as margin, which uses up all the money in your account, which is 100% of your account equity. If your account equity falls to $900 due to losses, your margin level, the ratio of equity to margin, would be 90%. At this point, you'd get a margin call, which is a warning that your funds are too low. If the equity drops further to $200, this is only 20% of what is needed for the margin, leading to a margin stop out. This means your trade is automatically closed to prevent further losses. See example using 500-to-1 leverage. Now let's say again, you have $1,000 in your account, but this time with 500-to-1 leverage. You open the same $100,000 trade, but here you only need $200 as margin, 20% of your equity. If losses drop your equity to $180, your margin level is 90%. Like before, you receive a margin call to alert you. A further drop to $40, which is 20% of the required margin, triggers a margin stop out, closing your trade automatically. What does this mean? Using higher leverage, like 500-to-1, increases your risk significantly. It allows you to open larger trades with less money, which means your buffer against losses is much smaller. In the 100-to-1 leverage scenario, a 20% stop margin means you still have $200 left. In the 500-to-1 scenario, a similar 20% margin leaves you with just $40, making it much easier to hit zero or go into negative equity, owing money beyond your initial deposit. Understanding these risks is crucial before deciding on the level of leverage for your trades. Leverage allows traders to control a larger position size with a relatively smaller amount of capital. In the scenario with 500-to-1 leverage, traders can control a position size 500 times larger than their actual account balance. While leverage can amplify profits, it also amplifies losses. Lowering the leverage on your trading account can be beneficial for several reasons, especially from a risk management perspective. Here are 5 positive reasons why brokers might take this step. 1. Enhanced risk management. Lower leverage helps reduce the risk exposure for both the trader and the broker. It limits potential losses in volatile markets, making trading safer for traders. 2. Promoting sustainable trading practices. With lower leverage, traders are encouraged to adopt more sustainable and thoughtful trading strategies, focusing on long-term profitability rather than high-risk trades that could lead to significant losses. 3. Protecting against market shocks. In times of high market volatility, lower leverage can protect traders from sudden market movements that could wipe out their capital quickly. It helps ensure that traders are more likely to withstand negative trends without facing a margin call or stop out. By implementing lower leverage, your broker is prioritizing the financial safety of their clients and the stability of their services, which ultimately benefits the broader trading community.